There we go. The roots of the modern stock market can be traced back to Amsterdam in the year of 1602 when the Dutch East India Company became the world's first publicly traded company. Yep. And that's why they called them Indians, the slaves. Yes, my people. They were Indians because they were the property of the Indian Company, or the Indian Company. Yep. Won't get into that. That's another rabbit hole that we will get stuck down with Alice. So, trade missions to the West Indies were risky and expensive, so shares and bonds in the company were initially sold to a large pool of interested investors to spread the risk. In turn, backers of the company received a guarantee of some future share of profits. As investors began speculating about prospects of the Dutch East India Company, a secondary market quickly developed for these securities. People bought and sold stock in high volumes, and a central register tracked the transfer of shares between parties. The modern stock market was born. Over 400 years later, not the modern stock market, but the stock market, the first stock market was born. So over 400 years later, the stock market is not that much different from the earliest exchange founded in Amsterdam. Modern computing and the internet have sped up transactions so that they can be executed in milliseconds, but the conceptual backbone of the market hasn't changed at all. Stock transfer agents. A stock transfer agent are the registrars that track share ownership for issuers and the stock market. Now, they're the third party that will cancel a share certificate for the investor that sold the shares and substitute the new owner's name on the official master shareholder listing. So there's over 130 stock transfer agents in the US and Canada maintaining the records of more than 100 million shareholders on behalf of 15,000 users. Investor. So, new technology, old model. Now, while modern stock transfer agents use today's technology, the same old model persists and it creates multiple industry problems. Now, what are some of these problems? Depositors and transfer agents are a single point of failure. It's a decentralized, expensive, old, outdated model. Registration, transfer, distribution, scrutinizing, and courier fees. Oh, wow. And the more widely held, the higher the administration costs. There's also limited transparency. Information asymmetry leads to market advantages. That means that those that have this information have a leg up on a trade as they're able to get in on the inside information. Forged securities still a concern, and there's a counterparty risk as a systemic risk as a whole. I talk about counterparty risk all the time. So furthermore, legal ownership rests with transfer agents in most jurisdictions. Investors, we do not have title. Yet the same time, the industry is gigantic, very, very large. 2016, the transaction volume alone was 1.6 trillion at the DTCC alone. New York Stock Exchange, 17 trillion. Okay. 11.1 trillion at NASDAQ, and TMX was 1.2 trillion. So in 2016, to proceed, there was 1.6 quadrillion in transactions from over 130 countries, bringing in fees over 130 billion. I'm trying to get you guys to understand these numbers. If everything is going to go to blockchain eventually, and we're only at 500 million, and you see that there's about 1.6 quadrillion there, oh man. There are over 100 other transfer agents out there as well, and many of them processing trillions of dollars of transactions. The problem with centralization? During the financial crisis, the problems increased due to the limited transparency, and this reared its ugly head, at its peak. Companies like Lehman Brothers, MF Global, they self-destructed, imploded, and nobody knew what kind of assets they had on their balance sheets. It was catastrophic. If an accurate blockchain record of all of Lehman's transactions had been available in 2008, then Lehman's prudential regulators could have used data mining tools, smart contracts, and other analytical applications to recognize anomalies. Yes, yes, y'all. Blockchain is the best, y'all. Regulators could have reached sooner or reacted sooner to Lehman's deteriorating creditworthiness. Instead, they just had their palms greased and looked the other way. So the lack of clarity and risk, it helped to drive the hysteria. Ultimately, it was catastrophic. Now, the entire blockchain. Modern tech is already used to speed up transactions in equity markets, but it could also be used to change how equity markets work. Think of a centralized model or a clearinghouse or a ledger. Instead of putting all stock transactions through a centralized hub, the blockchain can be used to directly transfer share ownership. Not can, but will. With all the manipulation and with blockchain being the alternative, pretty soon they will lose their market share. It's just that simple. Decentralized model or ledger. Here's how a decentralized securities platform could work. Somebody decides to transfer a security. The transaction is broadcast to a peer-to-peer network consisting of computers known as nodes or master nodes, baby. Validation. The network of nodes validates the transaction and the user's status using known algorithms. A valid transaction will transfer the title of the security. Now, once verified, the transaction is combined with other transactions to create a new block of data for the ledger and thus completing the transaction. Do you want to be a master node? You can. I can turn you into a master pro. I promise. Here are the multiple coins that offer master nodes, and master nodes is a great way for passive income. Oh, I got a lot of them. Got a lot. Yes, yes, yes. So there is a market out there. I mean, a serious one. We won't go. I mean, some of them. Look at the interest on some of them. Look at the interest on some of them. The cost is minimal to get into the master node, or it could be expensive. The yield can be low. The yield can be very high. It just depends on the coin and when you buy. Enough of that. So going back. So once verified, the blockchains combine with other transactions to create a new block of data for the ledger, thus completing the transaction. Now, in other words, stock exchanges could run using a blockchain under the hood with no longer any need for a centralized settlement or transfer of share certificates. This is cheaper, faster, reduces risk, and more secure, and it will also be fully transparent.